Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So they say to me, Andrew, I'm 72 years old this year, so I'm going to have to take my minimum distribution. And I said, well, they actually changed it again. They went from 70 and a half to 72 to 73 to 75 years old for your minimum distribution. And you're 72, so you actually don't have to take it till next year. Woo, she says. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about Give Smart, tax strategies you need to know by December 31st. And AAA 2025 is going fast. Man, is it going fast. But there was a lot
you're getting older, Daniel. It goes faster as you get older, man.
A lot of things happened in 2025. A lot of rules changed.
Yeah.
A lot of rules changed. And we want to come over some smart ways people can save some money on taxes. Some smart ways people don't have to pay the government money in taxes. Legal, smart ways people can do that.
Right.
And a lot of things changed in 2020 with the Secure Act 2.0. But a lot of those rules didn't go into effect until 2025. Man, that seemed a long way away when we were doing a show on the Secure Act 2.0. And we were talking about these changes don't go into effect until 2025, right?
Right.
That was
Boom, here we are.
Yeah, that was already 2021, right? Because they passed it like almost like retroactively or the last day of the year or something like that. Yeah.
Right. Yeah, but you're absolutely right. I mean, time flies, right? And boom, here we are. A lot of rule changes this year to make sure that people stay on top, because it's not just about how much you make that counts, it's about how much you get to keep that counts.
Yeah.
And we want people to pay as little in taxes as legally possible, right? And I believe that that's every American's right and responsibility to pay as least as legally possible. And that's part of what this show is about, right? How people can pay less taxes and, get themselves ready, right? Giving smart, when we give money away, that helps us to pay less taxes. That's what it's about. And, as we come up to the end of the year, it's kind of on a lot of planes too late to do tax planning for 2025. It's almost, you can do a little bit, but it's almost, once it hits January 1st, all you can do is damage control when it comes to taxes.
Right.
But this is a great time to be doing tax planning for 2026. And that's why we say give smart year-end tax strategies that you need to know before December 31st, because ideally you get a strategy together prior to December 31st that you can implement on January 1st that will help you in 2026. But it's not too late as well. Right. It might take some jumping through hoops, but there's still some things that can be done for people across the board. So pretty excited about today's show because I like saving people money.
Yeah. Yeah. And AAA, you said giving money to help save on taxes. And there's a couple ways you can give money, right? And that's what we want to cover today, because people are giving money and they're not getting it to they're not getting a tax deduction for that money. So That's why we're saying give smart, because there are ways that people may not know about where you can give money and get the tax deduction. Have your cake and eat it too. That's what we like to do around here.
Oh boy, do we? Yeah, we like cake. And Daniel, I think that's a great place to start, right? Because a lot of people are still going by the old rules pre-2018, right? And they don't realize, a lot of people don't realize what tax changes have been made since 2018 and how it actually affects them or doesn't affect them, right? But especially when it comes to giving, in 2018, they bumped up what's called the standard deduction so that in the past, prior to 2018, people could give to charities and then they would claim that on their taxes and their itemized taxes, and it would make more money that they could take off their gross taxes to pay less taxes. Well, in 2018, they bumped up the standard deduction. So for most people, that no longer qualifies. When they give to their churches or their synagogues or their charities of whatever kind, they're not getting any tax break from it. They're basically giving it with after-tax dollars. But there are ways, but there are certain people out there who are very charitable minded, certain people out there that are giving, that are obeying God when he says, test me in this and see if I don't open up the floodgates of heaven. You give me my 10% and I will flood blessings upon you. Certain people that are doing that and, getting their cake and eating it too, right? Getting the tax deduction. And for 2025, they've changed the rule again in 2025. So actually for people who are in retirement, 65 years old or so, they've actually basically bumped up the standard deduction, not really the standard deduction, but they bumped up how much you can take off even more. So all the more reason to be smarter with your giving, with your money from that standpoint. Now, let me just say this. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's show is Give Smart, year-end tax strategies that you need to know before December 31st of 2025. We have a great piece that we put together for you today, a paper that goes along with today's show that's going to help you, understanding what we're doing and what this is all about. And it's called Qualified Charitable Contributions. One way to be able to give and be able to get a tax deduction and whatnot. So we love to put this paper in your hand for free by calling us at 800-725-7616 for your free copy. 800-725-7616 for your free copy, called QCDs or QCCs, right? Qualified Charitable Contributions. Love to put this in your hand. Call now. You're listening to Financial Strategies because people don't know what people don't know. So we want to educate you. We want to inform you so you can make smarter decisions. Daniel, excited about today's show. Helping people to pay as little tax as legally possible. What has happened in the past is where, when laws changed in 2018, people were still doing the same thing that they had done prior to 2018, but not getting any credit for it. Now, as time has gone on, a lot of these people have gotten the idea and realized what's happening, but people are still living tax money on the table. They're still paying more taxes, I'm convinced, than what they need to if they knew the law and planned for it, strategized accordingly.
Yeah, so let's talk about the Secure Act 2.0. And that was a law that changed some of those things. And so Everything we're going to talk about today are taxes that have to be paid and taxes that maybe you don't have to pay. And you'll have to figure out which is which. But one thing that you mentioned in your opening statement, AAA, was talking about required minimum distributions. And this is something extremely important for our listeners to understand. A required minimum distribution is you come to a certain age and the government says, we have let you pack all this money away and get a tax break. We have let your money compound and grow for many, many years and gave you a tax break. You haven't had to pay any taxes on that money. And now it's time to pay the piper. Now you are required to take money out of your qualified plans. If that's IRAs, if that's 401ks, if that's 403bs, right?
Yeah.
And you have to take money out and pay us some taxes.
Hey, Daniel, let me just share something with you, right? So I talked to the sibling of one of our clients recently, and he's 56 years old. And he was saying, Andrew, I don't get it, right? Because when I'm in retirement, I'm supposed to be paying less taxes than now because, this whole idea of saying pre-tax as opposed to Roth. I said, yeah, but, when they came out with that concept in the 70s, people were living on a whole lot less than they are today. I mean, just look around. I mean, you lived in the 70s. You know what people had in the 70s compared to what people have today. People have a higher standard of living today. And, so people, when they retire, they're not in a lower tax bracket. They're in the same or higher tax bracket many times. And I said, so the government lied. Although, at the time they didn't know they were lying. But in retrospect, and what has come about is that That's not the truth. So that's a big thing when you're talking about this, Daniel, right? When it's time to pay the piper, we always thought it was going to be a issue where we're going to be paying less taxes in retirement, but we find out, no, that's not the case. And then for baby boomers, it wasn't until 1998 or so when Roths became available at all. And then it was only $2,000 a year you could put into it. So there, for baby boomers, especially Gen X's are much better off, but baby boomers especially didn't have much advantage other than pre-tax or after-tax savings. They didn't really have the tax-free savings available that people have today. So, I mean, there's a little bit of a tangent. I'm sorry, Daniel, but, I just wanted to throw that in there.
So Roths don't have to take RMDs, but if you have one of these other qualified plans, you haven't paid any taxes on that money. And so you have to take the required minimum distribution. And we get a lot of questions about these required minimum distributions because people have heard about them for a long time, but now they're trying to figure out when they're required. And so the law, the Secure Act 2.0 changed the law. So it used to be, as you mentioned earlier, AAA, 70 and a half. So if you were born 1950 or earlier, you're already taking those required minimum distributions. You already know what those are. Please keep taking them. And you were one of the 70 and a half people. Now we've got 1951 to 1959, right? And if you're in that age bracket, it's 73. Okay. So you're either going to be taking it this year, you've already just about started it, or you've got a little bit of time to take it. But if you are 73, then you're going to have an RMD coming up. If it's your first year to take your RMD, you can actually push it off into the following year as long as you take it by April. But what you have to pay attention to, right, is then you'll have to take 2 RMDs in that same year. Okay.
So drive up your tax rate. Yeah.
Right. And these are a big deal. Now, the good news for you, if you were born after 1960, is you don't even have to worry about this until you're 75 years old. So after 1960, you still got some time because they pushed that out to age 75. So the people who need to pay attention to this most is if you've already been taking your RMDs, or you're 72, 73 years old and you haven't started taking those because it's coming up for you.
Yeah. Well, and actually, in my mind, what we're talking about today is actually goes for people who are 70 and a half, because even though there's no longer a minimum distribution set at 70 and a half, there are advantages for people who are 70 and a half. So yeah, on the one hand, in preparation for RMDs, you can start preparing for it as early as 70 and a half years old. So I see by the look on your face, Daniel, that's what you were trying to say. So, okay. That's great. Hey, you listen to Financial Strategies with Daniel Agemy. We're excited about today's show. It's called Give Smart, year-end tax strategies that you need to know before December 31st, 2025. We're excited about today's show. We have something that we'd like to give you. It's called a animated video book to the next 5 first-time callers at 800-725-7616. We love to put in your hands this beautiful animated video book that will allow you it will inform you on 3 different tracks of retirement planning that you can use to help you put yourself in a better position if you're in or close to retirement. And whether or not, you could be in retirement and still benefit from this. So love to put that in your hand. Video book, ask for it by name, video book, by calling 800-725-7616 for your free copy. We'll be right back after this.
The biggest mistake retirees make is not switching from the growth model to the income model. Good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
QCD, RMD, MRD, all these different acronyms, they mean a lot of different things. There's a lot of confusion, but welcome back to Financial Strategies with Andrew and Daniel Agemy. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about Give Smart, tax strategies you need to know before December 31st. And AAA, as you had mentioned in the first segment, there's not a lot that can be done as far as tax planning goes this late in the year. But we're going to talk about some strategies people can still make happen, even in 2025, to help their bottom line, keep more of the hard-earned money that they have accumulated or built up or earned, right, AAA? And exactly. In the first segment, we talked about required minimum distributions, what those are and who has to take them. AAA, what are some of the tax savings people can do now that they are RMD age? They're not even RMD age yet, but they're 70 and a half.
Yeah, well, there's this beautiful thing. If people are charitable minded at all, that you can give money directly out of your IRA through what's called a QCD, Qualified Charitable Donation, or Qualified Charitable Contribution, where you can give to a nonprofit organization directly out of your IRA. It doesn't come into your bank account, and it goes directly to the organization, and you get credit for that. And you don't pay taxes on it. So you can give up to $180,000 for a married couple in 2025 without paying taxes on it. And it, normally if that were to come out of your IRA, you'd pay a bunch of tax, 30, 40% tax between federal, state taxes on that, depending on what state you're in. But this is where it can go directly. And so QCD, Qualified Charitable Donation.
So if you're charitable minded, you can have money go straight out of your IRA to a charity that you care about. And you can do $108 per person or $216,000 for a married couple, as long as you're older than 70 and a half. And that doesn't even show up on your tax return.
Yeah, it's a beautiful thing. Yep. Where a lot of people, what they do is they give to charities, but they take it out of their IRA, put it in their bank account. So then it shows up on their tax return, and then they give it to the charity. Well, maybe or maybe not, they're able to deduct it, like we spoke about in the first segment, that some people are not able to deduct and they don't realize it. But this way here, it never hits the tax return. So there's not a chance of paying double tax on it.
Yeah, that sounds pretty good to me. That sounds like a pretty neat way of taking your RMD and not having to pay taxes on it.
Right. Not everybody is charitable minded, but, we have clients who are not overall charitable minded, but every so often they want to give something to charity. Like, I'm thinking of one of our clients whose spouse had passed away, and they wanted to give some money to their deceased spouse's alma mater. And so they gave a chunk of money out of their first RMD that was not taxable. So it was a beautiful thing for the surviving spouse. And it was a beautiful thing for the organization because they got money they wouldn't have had otherwise. So the thing is, some people, there's a lot of people today. This is pertinent, I think, Daniel, because there's a lot of people today that we come across that don't have children. A lot of people have children. They want whatever's left to go to their kids when they're done. with it. They don't want to save for their kids anymore. They took their kids through college. They helped them with their houses, all these things. Now it's their money. But when they're done, usually if there's anything left, they want it to go to the kids. But, there are some people who don't have kids. So what's going to happen to their money? Well, charities are a great place to consider doing that. And whether you want to wait until you're passed away to do it, or if you want to do that prior to passing, there's various ways of doing it. So don't try this at home. Get some help to do it in a proper, smart manner.
Yeah, AAA, there's plenty of people who are giving. And as you had mentioned, that standard deduction just keeps getting higher and higher every year. It seems like it gets higher. And now there's that special deduction. There's that special senior deduction that brings the standard deduction. It's not a standard deduction, but you could add it together and call it a standard deduction. It brings it up even higher.
Right.
So most people are not going to be doing itemized deductions anymore. Especially people in or close to retirement, these people who are 70 and a half. Now you have to be, if you're 60, this doesn't work for you to do this charitable contribution, but you don't have to be RMD age, right? You don't have to be 73 or 75. Yeah. You just have to be 70 and a half, and you can start doing these deductions. One of the cool things about it is it does a lot for you because it can lower your Social Security taxes potentially, right? It can lower your AIG, right? And it can help you avoid help you avoid some of the Medicare tax.
Right. Extra Medicare tax that high earners have. That's all significant stuff. And that's why we have today's show on giving and giving smart with year-end strategies. You listen to Financial Strategies with Daniel Agemy. Today, to go along with today's show, we have a great book that we love to put in your hand that will help you. It's called Give to Get to Give. And Dr. Randy Dorsey does a great job with anecdotal stories of what his life has been like and what's happening in his life, that you can see the power of giving. And we love to be able to put this in your hands and encourage you, if nothing else, for free to the next 5 first-time callers at 800-725-7616. 800-725-7616. Call now. You listen to Financial Strategies. Daniel, one of the things that come to my mind is, when it's talking about this giving, this ability to give, and when people are doing it directly out of their IRA to the organization, like you said, it's very key because it eliminates and it cuts down on other taxes that they're paying. Right. It cuts down on people don't understand about Social Security that if you get too much income, you're going to be paying a lot of extra taxes because more Social Security is going to be taxed. And we don't have time to go into that today. But my point is that if you take the money out and give it in this way, it's going to lower your taxes on how much you pay for Social Security. So that's a beautiful thing.
Yeah, AAA. And we'll talk to people about income. We'll talk to people about setting up their accounts to create a certain amount of income, right?
Right.
Maybe they've got $500,000 in an IRA and they can get $25,000, $30,000 a year of income off of that. And they say, well, obviously everybody likes seeing their accounts grow over time and compounding, but some people are like, I don't need the income. Well, they can use that to do their RMDs. And some people are like, well, what do I do with my RMD, right?
Right.
And we've seen plenty of people who literally are doing what you said earlier. They're taking money out of their IRA, going into their checking account, and then they're giving to charities from there. So it's just eliminating the middleman. So you could take that $25,000, $30,000 of income and pay that directly to a public charity, a church, hospital, right? Educational, you mentioned that earlier, a public foundations, right? You just send that straight to them. Some IRAs will let you get a checkbook and you can write a check right out of the IRA to do that, or you can have the custodian just send it directly to it. But the key is it's coming out of the IRA. We've seen people use their income that they don't need and it doesn't affect the inheritance that they're leaving to whoever it is.
Right.
Because they're just sending the income that they're earning each year to these causes that they care about, right?
Right.
And we've seen people roll their 401ks over after they're 59 and a half into an IRA to position themselves in a way where they can be ready to create that income and then get set up to send out these charitable distributions tax-free.
Right. Because that's the key thing, is that to do what we're talking about is not so easy. Not every financial company does it. And it takes a lot of effort. You know, if your financial advisor will do it, it's going to take more effort on their part. So sometimes they don't want to do it because they're not getting paid for helping you like this. But so it's very key, not, how this is done. And you have to be careful to make sure you're doing it right. Because if you don't do your RMDs correctly, there could be as much as a 25% penalty and taxes on that penalty that would come out. So a lot of things to take into consideration. And that's where, we want to be able to help people understand what they don't know, because people don't know what they don't know. You're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is Give Smart, year-end tax strategies that you need to know before December 31st, 2025. And today, going on along with today's show, people are often asking, well, can I retire? When can I retire? How much do I need to retire? All these different kinds of questions. If that's you, I'd love to be able to have a personal conversation with you to tailor answer your questions. And we call this the RRR conversation, Retirement Readiness Report conversation. And from that, we'll be able to direct you for how you can know unequivocally that you can retire, or when you can retire, and what you need to retire on. If you want to be able to have that conversation, call us at 800-725-7616, 800-725-7616. With no obligation, free of charge, we'll have that conversation. 800-725-7616 for your RRR conversation. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
And welcome back to Financial Strategies with Andrew and Daniel Agemy. Taxes, income tax, sales tax, property tax, death tax, estate tax, taxes. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about Give Smart, tax strategies you need to know by December 31st. And AAA, yes, there's always taxes. It is insane sometimes to think about how much money we pay in taxes when you start adding them all up. Typically, people just think about the taxes that come out of their paycheck. But it's like double and triple taxes. It feels like sometimes when you add up what you pay. I already paid tax on that money, and now I'm paying tax on it in a different thing, right? It's crazy.
Right.
So it's a big deal if you can save some money or make some money non-taxable that would have been taxable, right?
Right. And that's a very good point, Daniel, right? Because you have income tax, you pay tax on the money you earn. And then what do you do with that money you earn? You go out and you buy gasoline for your car, and there's gas tax and sales tax on that gasoline. That you've already paid tax on that money. Now you're paying more tax, right?
Or you invest it. You invest it, right? You invest it into an individual account, and then you pay taxes on the money that grows inside that account, and you pay it again, and then it just continues.
Right. So exactly. So my key with how I started this was, how can we pay less taxes, right? Because nobody wants to pay more taxes than they legally have to, and they shouldn't as Americans. That's our right and responsibility. I believe that to pay as little taxes as legally possible. Emphasis on legally possible, right? And so I'm reminded of the client who says, Andrew, I don't mind paying you fees. I just don't want you to make more money than me. Right. And how many, and we don't, right? Our clients make more money than us when it comes to that during their portfolios. But how many people can actually say that about their financial advisors? I mean, I see a lot of financial advisors that are taking basically all of the interest, all the dividends that are coming in or close to it. So sometimes they're getting paid more than the accounts are going up. But anyway, when we're talking about taxes, and we talked about one option as far as people can be charitable minded, give smart with qualified charitable donations, QCDs. And then there's some other things that people can use if they're charitable minded. Right, Daniel? That go beyond that.
Right. So we talked about the simple, easy, almost everybody can do it once you're 70 and a half or older and you have an IRA, right? That one's pretty straightforward, and it's really a great thing people should be taking advantage of, that charitable donation. But there's charitable remainder trust, right? People have probably heard of these things, and donor advised funds. And these are typically used for people who want to get a big deduction up front. So maybe you've got some appreciated real estate, you've got some appreciated stocks, you're very charitable minded, and you can put money into, there's different things. We're not going to get into these too much, AAA, but just so people know that if they have a big influx or they have stocks they need to figure out what to do with big appreciation, real estate, things like that, you could put the money into, a charitable remainder annuity trust or a charitable remainder trust where you put the money in and you collect a lifetime income. And then when you pass away, the remainder of the money goes to a cause that you care about. This doesn't fit a lot of people, but we get a lot of questions from people about these things because they hear about them and they say, well, I could put my money in there and then never pay taxes on it. It doesn't exactly work that way, but there are those special types of vehicles where you can put the money. It's basically like giving the money to, let's say, a hospital. It's giving the money, a nonprofit. It's giving the money to a church. It's giving the money to a university. You get income, you're taken care of for the rest of your life, and then they get all the money when you pass away. There's big tax benefits for doing that.
Right.
The other one that we see a lot of more people have interest in, and that is, that's the donor advised fund. And that's where you can take money, right? The donor advised fund, it's another trust that you would set up, and you take money, you put that into it. It can be appreciated stocks, it could be real estate, it could be contributions. And you could get up to maybe 60% or so of your adjusted, or AIG, right? Your adjusted gross income as a deduction. And so that as an immediate deduction. So if you just sold a business or you had a big year where you made a lot of money and you're not expecting to do this, it allows you to put money into an account that you advise. And that's pretty neat because you get this big deduction up front. And now because standard deductions are so high, maybe you're only giving $7,000 a year to, let's say, your church. This would allow you to put a large sum of money, let's say $100,000, get the deduction in the first year, and then it grows tax-free inside the trust, and you get to pay it out to whatever type of organization that qualifies over time. You could use your dividends and interest, and the fund basically never go down, right? That $100,000 stays in there for your whole lifetime, and you get to be like one of those big billionaires, right? Who's doing all the philanthropical efforts, but you just did your own on a smaller scale. That's available to regular folks.
So cool, Daniel. So cool. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Give Smart Year-End Tax Strategies You Need to Know Before December 31st of 2025. Today, going along with what Daniel said, Daniel keeps talking about, and rightly so, using your dividends and interest to maybe fund it, or use dividends and interest to actually give away every year so that you still have the principal in there to keep working for you. But the question is, how are you going to allocate your monies properly? How are you going to allocate? You may need to make sure that your monies are allocated properly in order to take RMDs from interest and dividends as opposed to taking them from principal, or you're giving from dividends and interest as opposed to from principal. And so that there's more to go around for everybody if you're doing that. So we have this paper that we put together today for you that will be able to help you, inform you further on these things, called Are Your Allocations Right for RMDs? Are you allocating your money properly? Well, we would love to put this in your hand for free, no obligation, by calling us at 800-725-7616 for your free copy. 800-725-7616 for your free copy of Are Your Allocations Right for RMDs? Call now. Listen to Financial Strategies, because people don't know what people don't know. And we're talking about year-end tax strategies for people to know, to be able to put them in a better position. Daniel, this is pretty exciting stuff, I think, because I don't like to pay more taxes than I legally have to. And I'm excited about giving opportunity to people to be able to pay lesser taxes. And, we've talked about the Qualified Charitable Donation, QCD. We've talked about Charitable Remainder Trust, CRTs. We talked about donor advised funds. Were you done? Is there more to go through on that? And are there other things that people can save on taxes?
So there's different ways to save on taxes. We talked about, as you mentioned, taking the money out of the IRA and not having to pay taxes on it. That's an amazing thing, right? These other two that we just mentioned, the CRT or the donor advisor fund, those are more ways you have a big year of income. You can put some money into that and then do philanthropic, at least with the donor advised fund type efforts, right? You just gave away a paper that talks about, are your allocations, is your investments set up for your RMDs? Because you don't want to spend down your savings, your account, your principal, people use different words, to pay your RMDs or to take your RMDs or to give charitably, ideally, right? That paper is explaining that when you get set up properly, you can do both. You can pay your RMDs and keep your investments intact. You can pay these charitable donations, get it out tax-free, keep your investment intact. Same with this donor advised fund. You can put it in it. You can do the philanthropic ventures, keep the money intact, and it's in a trust so it can continue on for a long time when it's set up that way. But you got the original tax savings from putting the money in. There's this other thing that has come up because of the Secure Act 2.0, and it's kind of a weird thing. You want to take a stab at this one, AAA? The super, what do we call it here? The super catch-up contribution. Yeah. Well, this is such a weird thing, because when they came out with Secure Act 2.0 and they said, okay, at this time frame, at this, 2025 or whatever, right? People who are 60 to 63 years old, and it's only for those people, they can actually put more money into their retirement plans than anybody else. And it is the weirdest thing that it's only for people 60 to 63 years old this year. And I don't exactly know how that's going to work out. My guess is it's going to be kind of like a rolling thing. So next year is going to be for 60, 63 people. But whatever the case is, the point is you can put more. And
how much more? I think that's as much as an additional $10,000. Now, this may not, a lot of people don't have an additional 10 grand, right? But there are people that have an additional 10 grand. And if you can put an additional 10 grand in and you're in the 22% federal bracket, with state, you're saving $3,000 by putting in taxes right now, by putting an extra 10 grand in. So it's another opportunity people have to save more on a tax deferred basis if that fits their needs, if that fits them. And I want to say if that fits them because not everybody's the same. And that's where there's certain personalities, entertainment personalities, financial personalities out there that I don't like their advice because they're giving generic advice. And even though that may be pertinent to a certain individual, it doesn't fit everybody. And that's what I'm trying to say is here's ideas, but it doesn't fit everybody. There are some people that this fits, but there are a lot of others that it doesn't fit. So, don't try this at home. Get the right help.
AAA, I had a client ask about that because he is in that window, right? That 60 to 63. And he's going to be retiring soon and he's going to get paid out all this vacation time. And so that's somebody, right? So instead of with all the catch-up contributions, he could potentially do close to $40,000 into the 401k, get the deduction.
Yeah.
Use the vacation time to do that and not have to pay taxes on all that money. And then once he retires, take it out over time or let it compound or whatever. Which is more strategies, Roth conversions, right? But it fits certain people and you just got to know about it so you can ask the questions.
Right. Exactly. That's a great thing. That's good, Daniel. Glad you brought that up. You listen to Financial Strategies with Andrew and Daniel Agemy. And this father-son team coming to you to help people know what they don't know. Today's topic is Give Smart year-end strategies that you need to know before December 31st of 2025. And today we have a paper to go along today's show to help you save more on taxes, which is it's a checklist, tax saving strategies checklist. And are you paying more taxes than you need to? Use this checklist to help to stay on track during tax season so that you and into the new year so that you don't pay more taxes than you legally have to. Love to put this paper in your hand for free, this checklist in your hand for free by calling us at 800-725-7616. No obligation, 800-725-7616 for your free copy of the Tax Saving Strategies Checklist. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Welcome back to Financial Strategies with Andrew and Daniel Agemy. Daniel, some of our newest clients, I'm going to call them Tom and Sally, right? Came in recently because they turned 73 years old this year in 2025. And what that means is that they have to start taking their required minimum distributions. And they know that. They came to an RMD workshop we did 5 years ago, but they haven't done anything. But this year they did something and they came in October, November, and we're taking care of their RMD for them. Very crucial before December 31st of 2025, if you turn 73 during 2025, to look at and make sure that you do RMD, required minimum distribution planning, so that you don't have big taxes and penalties to pay. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about Give Smart year-end tax strategies that you need to know. AAA, there are some deadlines coming up. Those RMDs are a big one. Now, if you are 73 this year, you could potentially push that off until next year. But like you just mentioned, you need to understand the consequences for going either way, because you could cause a big tax burden in 2026 if you do push that off further.
Right. And Daniel, that's where, some of the things we talked about were pretty cool, right? Because the donor advised fund, you may not know who you want to give money to, but you could take your RMD and put it in there. So you're taking it, and you're giving it away, but you can decide next year who to give it to. So that's a great option. There are different things that people can do, but not just for 2025, but also what we're trying to bring across is, hey, think ahead to 2026. What do you want to do in 2026? And your point is so important for people to get and to take, because if they don't take it, if they're 73 in 2025, they don't take it this year, that's fine, but they have to take it in the first 3 months of 2026. And then they're going to have to take another one in 2026 for 2026. So that's two. And that's where it can become very burdensome and affects their Medicare premiums. It could affect their amount of tax they'll pay on Social Security if they don't do it right. They could potentially, if they're slack on it at all, they could potentially even have a 25% penalty that they're going to have to pay. So it's very important to make sure that things are done properly, in order. And so what I say to people is, don't try this at home.
Yeah, AAA, talking about that, we make decisions by decision or indecision, right? We make decisions on purpose or because we're forced to make decisions. And so make sure that one, you sit down, you write it out, you think about it, because for some people, it could make sense to delay it because maybe they're going to retire at the end of the year, and then next year they won't have any earned income, and it makes sense to take 2 RMDs in the same year, right?
Yeah.
But being forced to take that, and maybe you retire next year and you get paid out a year, and now you've got vacation time paid out, you're earning paid out, and 2 RMDs, you wouldn't want to do. So you really need to look at that. When we're talking about making decisions on purpose or by accident, AAA, we've been talking about required minimum distributions, and these are for people who are 73 years old now. You can start taking them out early if you want to use a QCD. You could start taking them out at 70 and a half, so you get some tax breaks for taking them out. But there is inherited IRAs, and the rules for those changed as well. And all the rules really came into play in 2025. So you got to get serious about these. We've had a lot of people come in who've been messing around since 2020 because they didn't understand the laws and they weren't enforced and all these things. But 2025 is the year you have to get serious about these. And talking about making decisions by purpose or by accident, these can be like a bomb. Right? Because all the money has to be taken out in 10 years. So if you don't plan ahead, and maybe you got this in 2020, you've only got 5 years left to get the thing drained.
Right.
And so you don't want to end up with $250,000 of income that you have to take out in 1 year that wasn't anticipated, because that could make all your Social Security taxable. That could give you IRMA problems. That could do all these different things that you weren't expecting, and make the taxation on that 50, 60% potentially when you add it all up, right, AAA?
Right. Exactly. Yeah. I appreciate your passion on this stuff, Daniel, because, it's important for people to look, right? Because this is their money. You and our listening audience, this is your money. Nobody's going to care more about your money than you. Now, there may be people that care about it a lot, but nobody's going to care more about it than you. And their hands are going to be tied. If you don't care about it, they can only do so much. I know that for some of our clients that don't return our phone calls or those kinds of things, it's hard for us to do much of anything outside the normal routine if we can't speak with them and grow that relationship with that. So very crucial. Now, people don't know what people don't know. And so because of that, that's why Financial Strategies with Daniel Agemy exists. Give smart year-end tax strategies that you need to know before December 31st, 2025. And we have a book to go along with today's show that we love to give you. We think it goes along beautifully. It's written by our friend friend, Dr. Randy Dorsey, give to get to give. Randy talks about in this book the idea of how when you give, it's kind of like the law of attraction. You give and then you end up getting more, but not just for your own benefit, but to be able to give more. And then there's actually many blessings that happen when you do give. So since, we're in the holiday season, Thanksgiving, Christmas, everything like that, we think about giving, we think about gratefulness, we think about gift giving. And so this is a great time to be able to look at this. We love to put this book in your hand. Give to get to give. Yours for free. The next 5 first-time callers at 800-725-7616 for your free copy. 800-725-7616. Call now. Daniel, as we move forward today with the show and the whole aspect of tax planning and strategies to use in 2025, at the end of 2025, one of the key things I want to bring up is just, again, what we talked a little bit about earlier was the key to all of this is making sure that your allocations are right. Now, a lot of people invest in what I call roosters, and when you need to take money out of your plan and eat in retirement, you're killing a rooster. And the problem with that is that roosters, you can run out of roosters. If you invest in chickens, well, chickens have a renewable resource of eggs, and you'll always have the eggs, and you'll never run out of eggs. You'll always be able to eat. So how you allocate your money is very key. And too many times people run out of money in retirement because they forget to change from the accumulation aspect and capital appreciation aspect into a distribution mindset, into a more income mindset that will make sure that they have the eggs and be able to have their eggs and eat them too.
Yeah, that's true, AAA. That really makes a difference when people are taking RMDs, as I had mentioned earlier, taking it from income payments as opposed to drawing down the assets that you've built up or your principal.
Right. You don't want to take from principal. I mean, a lot of people who have gone through the depression understand, a lot of them are passed away at this point, but they pass on the wisdom of don't spend principal, spend the interest, spend the dividends. Important thing to be able to look at. And, a lot of financial people today are not looking at that. They're so used to capital appreciation in the stock market going up, share prices going up from $10 a share, $11 a share, $12 a share, enamored with that so much that they forget about the importance of dividends, where dividends and interest are where the actual compounding takes place, to where you actually get more shares and more dividends and interest, and more shares and more dividends and interest, as opposed to just your share price going from $10 a share to $100 a share, or whatever it may be.
Right. Well, and we have some checklists that we put together for people so that they can make sure that they're getting these things done by the end of the year.
Yeah.
So you want to go through that first checklist we put together for people?
Sure. Well, this year-end checklist, if you're RMD age. So first of all, have you taken your RMD for 2025? What's your RMD planning? Are you going to take one this year, one next year? You're going to take 2 next year? What is that going to be? As part of that whole thing, whether it's this year or it's for next year, consider a qualified charitable donation, a QCD, to satisfy all or part of your RMD tax-free, because you didn't pay money on that IRA when you put it in, or that 401k, and then you can give it to the charitable organization totally tax-free. Beautiful thing. Another thing is
one thing on that you didn't mention is you are you taking it from your capital appreciation, or are you taking it from your dividends?
Right. That's a good point.
Because if you're taking it from dividends, guess what? It comes in every year and you don't have to market time. If it's capital appreciation, when do you take it? How do you know when is a good time to sell?
Right. And how do you know what the market's going to do? Right. And even though it might be good now, and a lot of people say, well, I'm going to wait another 6 months so we'll grow more. Well, the problem is it could turn into a capital depreciation, and that's problematic. So, yeah. And then, the custodian that you have, the IRA custodian, it's important that you have the right custodian so that they can do a qualified charitable donation for you, because not all do, or do it properly. Or do it the way that you want it to, I should say. So key things to be looking at, right? What else?
Yeah, AAA, I think those are the big things.
Okay.
I think those are really the big things that people need to watch. Are you RMD age? And have you taken your RMD? If you're not sure, you better get on the phone, make some phone calls and find out, because the penalties are a big deal this year.
Yeah.
Do you know about QCDs? Do you need to know more about QCDs? We have that paper that we're giving out if you want to know more about those QCDs and how you can get those RMDs out tax-free.
Right. Yeah.
As you said, the custodian...
Daniel, let me say this. Let me just say this. I think is worth noting is that if any of you have inherited an IRA, beneficiary IRA, inherited IRA, you cannot take QCDs from beneficiary IRAs. It has to be your own, and you have to be at least 70 and a half years old to do qualified charitable donations from that. So just a point to be able to understand. So go ahead.
And those custodians, as you mentioned, a lot of times I haven't seen any 401k that will let you do it. So does it make sense to roll your 401k over into an IRA, take the handcuffs off, and be able to do these charitable contributions? But even more than that, the income, right? Taking these charitable contributions out by using income as opposed to capital appreciation.
Yeah, the interest as opposed to using the principal. Yeah. Good stuff. You've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been Give Smart, year-end tax strategies you need to know before December 31st, 2025. It's been a joy to be with you today. Hope you got a lot out of it, that we added value to you. And as a closing gift, parting gifts for you today, we have a RRR conversation, retirement risk report conversation. Can I retire? When can I retire? How much do I need to retire? A lot of questions people have when they're in or close to retirement. And so we love to be able to put this in your hand, or be able to have a conversation with you so that you can understand, put in your hands the information you need to make a good decision about when to retire and what you're going to need to retire on. You can have that conversation with me by calling us at 800-725-7616, 800-725-7616. Ask for it by name, the RRR conversation with AAA. Okay? And listen, hope you have a Merry Christmas, Happy New Year. And if you want your retirement to be stress-free, invest more for the I rather than the G. Peace.